Welcome back, everybody, to another episode of Multifamily Report, Market News and Industry Insights. I'm your host, Travis Watts, the Director of Investor Development here at Ashcroft Capital. In today's episode, do something a little bit different. I'm going to do a 2024 market update. What we're talking about is multifamily commercial real estate in this episode. And I just want to give you a quick glimpse of what happened in 23, what's happening right now currently, and what we might expect as we move forward through 2024. This is for educational and informational purposes only, never financial advice, never tax advice, never legal advice. Please always seek licensed financial advice when it comes to your own investing. Now, with that top of mind, I want to kick this off with a slide from the National Apartment Association. And here's 4 bullet points that they pinpoint as we begin 2024. First of all, for nearly 2 years consecutively, we've had 3.9% unemployment, which is historically low and is not an indicator of any type of bad economy or a nasty recession. It's actually very healthy. So something to keep in the back of your mind. They are projecting positive rent growth between 2.5% and 3.7%. Multifamily starts, meaning developers who are starting new construction and intend on delivering that product in 2 or 3 years, that is declining, and it's declining quite steeply. And we'll look at some more data on that as well. And they expect inflation to be below 3% and then nearing the Fed's target as we get into 2025. So just some food for thought before we get into the analytical details of each sector here. So interest rates, let's dive into it. How did we get here? So March of 2022, the Fed steps up and says, hey, we're going to start increasing rates because the economy is overheating and we need to slow things down. We need to cool inflation as we peaked out in 2022 at around 9% with core CPI inflation. So they came in with a 1/4 point, 1/2 point, then they got really aggressive through the summer and fall of 22, and then they started to taper back down at a 1/2 point, 1/4 point. Now they've been on pause for several meetings, and as we stand today, this is the forward-looking projections for where rates might go in the future. So this is a snapshot of the market futures implied, Morningstar forecast, the historicals, and the Fed themselves, and where they see rates going as we move forward. So the good news is all of these sources project that rates are coming down. The question is, how soon and how fast? That we don't know, so take these with a grain of salt as always. I don't have a crystal ball, not telling you this is exactly how it's going to play out, but these are some data points to consider. So what's important about this is in commercial real estate, when interest rates come up, valuations come down as a general rule of thumb. So we've seen a lot of distress and hard times because of it. Good news is if you're able to buy a deal today and it cash flows and it can pay its debt with higher interest rates, then as you hold it the next few years, rates are anticipated to come down, which could make that deal even better. So multifamily rent, where are we at? So a couple different sources here. This is from Statista, and they're showing, we're about 1,700 as a nation for rents. This goes all the way back to 1980, and you can see how we got to where we are. This is Yardi Matrix and their latest data as of December of 23. It's about 1,709 to be specific, according to Yardi Matrix, on where multifamily rents are. As you can see, we've been pretty stagnant since the Fed came in and started raising rates. Rents have just really held steady for about the last 1.5 years or so. Multifamily rent growth. Okay, this is a base case forecast brought to you by CoStar, and you can see the line here. That's where we are today, entering into 24. They're forecasting that rents continue to go up year over year, including 2024. Taking a look at a few other sources, CoStar, RealPage, Yardi Matrix are 3 major reporting outlets that report on this type of data. 2023 occupancy around 92 to 95% were the projections. Came in mostly in that range, about 93, 94 as a national average. And they anticipated rent growth to be anywhere between 0.1 up to 2.9. Pretty accurate, is a pretty flat year in general. As we moved into 2024, they're projecting occupancy to be slightly better on average, but most importantly, rent growth to be much higher than 2023. And when I say much higher, 2.5% up to 3.7% as compared to 0.1 to 2.9. And as we get into 2025, occupancy roughly the same still, but rent growth even higher, ranging from approximately forecasted 2.9 to 4%. So stronger and stronger as the years tick by is kind of the trend. Something to think about if you're getting into new deals today that are projected to be held about 5 years or more. There's certainly a bull case to be made on the rents. Now, here's a base case scenario brought to you by CoStar on pricing. This is the price per unit. Again, the forecast is where you see that vertical line moving forward to the right. So a softening that continues throughout the year and possibly into 25, and then a fairly substantial rebound after that as the economy and rates normalize. New supply coming on the market is something important to pay attention to. We have one of the all-time highs in this country for new units coming to market in 2024. Now, that's not a good thing because ultimately what that is competition for existing properties that are already out there in the marketplace. These new units need to be absorbed by more people. But the thing is, if you look at 2024 and 25 projections, new inventory just falls off a cliff moving into 2025. This is all because in 21, when the market was hot and there was all kinds of euphoria out there between, stocks and real estate and the broader economy, everyone's throwing money everywhere, stimulus checks are everywhere. A lot of developers decided at that moment to get involved and get a piece of the pie, so to speak. And unfortunately, rates worked against them, but they still are completing these units, bringing them to market. And so that's why we see that all-time high hitting the market today, because it takes 2 or 3 years to develop a new multifamily apartment building. So again, maybe not so good news for existing properties that are already out there. It's going to be a pretty, tough year in that regard. But moving forward, if you can hold on to those properties or invest into more properties this year and next year, certainly the bull case to be made. Construction starts, another amazing metric to consider. And this is brought to you by CBRE. They're saying by summer of this year in 24 that it could be down 70% from the peak. And again, this is new construction starting up, down 70% from the peak. So that's only putting us behind in the amount of units that we need as a nation to house the amount of people that we have here. And so again, it kind of sets us back numerous years. And you see this every time the economy goes through a shift, like the Great Recession or even the onset of the pandemic and the dot-com bust. Developers pull out and take a pause. We fall further behind in supply, and then they join back in. But there's that 3 to 5 year lag, and so it just makes it really hard for us to catch up as a nation. Sales volume, these are deals that are actually selling and transacting, plunged 61.7% year over year. That was as of Q3 of 23. You can see that there on the right of your chart. So what this implies is that if you can hold on to your properties right now and not have to sell them and not have to discount them in order to sell them and make it through the storm, quote unquote, this commercial real estate recession that we find ourselves in, then do it. That's what everyone wants to do. The sales that are happening out there are sales that have to be made either by an obligation or a contractual agreement, or because you've held this property forever and you still have some equity in it. So you might want to just cash out and get what you can. But in general, people are really wanting to hold on to their properties right now in hopes that 25 and 26 bring a much stronger market and economy so they can get better valuations on these deals. So it's going to be another slow year for transactions. Last year we closed 3 properties and that was down from 7 or 8 in previous years. So, it may be another year like that. We may get lucky and have more deals. I don't know what's to come, but just something to keep in mind is probably going to be slower. Here's a base case forecast put together by CoStar, bringing all these metrics together in one slide. So net absorption is how many people are being absorbed by the new net deliveries, which is in blue, and the vacancy rate. So how vacant are these properties? So as you can see, new inventory begins to hit the market, not enough people to fill them up. And then as we move into 25 and 26, it starts to stabilize. And as we move 26, 27, there is forecasted to be more people needing a place to rent compared to how many units are available. Vacancy peaks up a little bit from here and then slides back down to pretty much where we are today by forecast. Multifamily debt, a lot of people talking about this. $682 billion in multifamily loans set to mature between 23, which is already over, and 25. So the peak of this is actually coming in 24. So a lot of floating rate debt out there. A lot of commercial debt is very short term. A lot of bridge loans, 1 year, 2 year, 3 year, 4 year, 5 year kind of debt. So it's all coming due and it needs to be reset. And so, that's been the challenge and the hurdle is, do you do a refinance? Do you do pref equity? Do you do a capital call? Do you pause distributions? Do you go ahead and sell an asset if you have a fund? I mean, there's a lot of ways that you can work these scenarios, but the fact is that the majority of this debt comes due in 24, which should increase the deal volume that we see in those who are seeing some distress and need to offload their properties. Migration trends, there's the snapshot of the US. This is by Moody's Analytics, published by Berkadia. 2024 to 2030, this is what they project the migration trend to be. I like to highlight here on the right of the 20 top markets across America. We operate in Dallas, Texas, which is one of them, South Florida, Orlando, Atlanta, Tampa, Raleigh, Durham, or Chapel Hills, where we actually have our property. It's a submarket of Raleigh, and Jacksonville, Florida. So we are operating in the strongest markets across America, which is great. And if you want to look at some other data on this, this is from the US Census Bureau. These are the top 10 states by numeric growth from 22 to 23. Texas, Florida, North Carolina, and Georgia are 1, 2, 3, and 4. Those are all our markets that we operate in. And, the South has really absorbed the most amount of people across the nation. And once again, the markets here on the right, Dallas, Atlanta, Raleigh, Durham, Orlando, Jacksonville, 61% of the absorption in general across the nation has been in these southern states and in the Sun Belt. So we continue to see positive momentum in the portfolio and in the markets that we're seeking to continue buying in. Cost of owning versus renting. One of the largest gaps on record in US history right now. If you go out there and you're either a first-time home buyer or just a home buyer in general buying a home in 2024, the differential is almost $1,000 per month between a rent payment and a mortgage payment. And what I like to say about a mortgage payment is that's the minimum you're going to pay to be a homeowner. That doesn't even include property tax and insurance and HOAs and maintenance and upkeep and remodeling a house and all these other costs, plus down payment and credit scores and all the rest. Renting, on the other hand, is the most that you're going to pay. You know what you're going to have every month. And if your appliances break or you got flooding or fires or issues, the property management takes care of that for you. And in most cases, your insurance can be substantially lower. So really a bull case to be made for renters, both by lifestyle and by necessity. Cap rates, valuation metric used in commercial real estate. Cap rates have gone up. They've kind of reversed on us over the last couple of years since the Feds come in to raise rates, which was to be expected. They've come up, and that's a negative for pricing and valuation sake. However, once again, 25, 26 and beyond, the forecast is that cap rates come back down once again as things normalize and as values build back up once again. Couple lessons from history. Here's a chart from 1940 to 2024 of US rent growth. Not to suggest that rent always and will forever just go up, up, up and away, but it really has since 1940. There's been a few periods of stagnation and slight decline, like the Great Recession, as you see there, 2009. But if you look at any 5-year period, rent growth has really been positive across the board. So something to consider as we move forward and wonder about where are rents headed in the future. Since 1978, this is a really interesting stat. This is the first year that MPI data was available. Private equity real estate's offered a total return of 9.2% on an annual basis, with 7% of that coming from the income on the property. And as you can see here, that's the government stated inflation. There's the income, and there's the appreciation within apartments. So once again, something to consider as we move forward. I want to talk a little bit about value add business plans, something I'm a huge advocate of, something we do here at Ashcroft Capital exclusively. What value add means is that we buy older pre-existing properties. They're often outdated, they often lack modern amenities, and they have the potential to increase rents. So there's really three outcomes if you think about buying a product type like that. If rents organically in the market go up, you've got a good chance of successfully executing a business plan off that basis. If rent stays stagnant and flat for the entire time you hold the property, but you're still adding value and increasing rents because you bought below market rent level and you're raising them up, there's a case to be made for that. And if rents decline, that's an unknown. It depends on how much rents decline. Because if you buy a property that's already 200 below the market today and you bring it up 200, and then the market softens up and drops $100 a month, you still might be profitable in that scenario. So I just like stacking the odds in my favor, and something to consider when it comes to value add. So I'll leave you with problems and solutions right now in the economy in terms of real estate. So problems, we have a shortage of housing, depending on what metric you look at, between 3 and 6 million homes behind as a nation. And according to the stat here, the US needs 4.3 million new apartment units between now and 2035 in order to mitigate issues related to apartment demand and the shrinking supply of affordable housing. Mortgage payments have more than doubled, as most of us know, over the last couple of years, which has made single-family home ownership much less affordable. And there's, again, that same metric that I showed earlier, the difference between home ownership and renting, about $1,000 a month gap right now. Home prices remain elevated despite the Fed bringing rates up. You know, single family real estate operates a little different than commercial, and it has a lot to do with what kind of debt is on the properties. Most people buying a home have 15 to 30-year mortgages. So that's pretty long term. In the commercial space, it's usually 3, 4, 5 years, stuff like that, shorter term debt. So that's why it's more problematic when rates change drastically really quickly. But with that being said, homes continue to climb higher despite these higher rates. So what happens if rates go lower? Well, we might even see more increase in valuations of single family. Who knows? I don't have a crystal ball, just saying, something to think about. And so what's the solution? Value add business plans, as we discussed. You buy something older and outdated, you update it, make it better, nicer, newer, safer for the residents. You focus on affordability. We like Class B apartments. That's not the new built, luxury, high end, all the bells and whistles, but it's also not the lower sector of this asset type. We're right in the middle. We're with the middle class families and the middle income families across America. That's where the bulk of people are. And last but not least, buy the dip. This is your opportunity, 2024 and 25, as we see the decrease in pricing. If you're able to buy a property or invest in a syndication or a private placement, and you're getting these properties at 20 to 25% lower prices than compared to previous years, that's the golden opportunity. If you can get cash flowing deals that cash flow at higher rates, and then rates end up coming down, you can do that much better. As Warren Buffett likes to say, be fearful when others are greedy. That was 2021. Be greedy when others are fearful. That's 2024. I'm Travis Watts, the Director of Investor Development here at Ashcroft Capital. That is my email. That is my phone number. You can visit AVAF3 for more information or scan the QR code on your screen for current offerings. Be happy to be a resource, happy to answer any questions you have. I appreciate your time today. I hope this was helpful. And until the next episode, have a great week, everyone, and we'll see you very soon.